Get ready to look past the headlines and really dive deep into the risk today. We are analyzing 3 powerhouse high dividend ETFs. One that promises income, but, well, it hides massive risk, and another that's supposed to be the pillar of stability, but is actually quietly underperforming the market by a mile.
Yeah, it's quite the contrast.
We are talking about a fund offering a, frankly, mind-bending 124% yield and a dividend aristocrat getting crushed by the AI boom. Stick around because you won't believe the tax landmines we uncovered. They could cost high earners thousands.
Yeah, our mission today is super focused. We're providing a critical data-driven analysis of ULTY QQQI SCHD. We're going strictly by the numbers here.
Right.
The true underlying risks, the tax efficiency, and those structural differences that really define their future performance. You're going to see exactly why their returns differ so vastly, especially, when we factor in risk.
Okay, and before we unpack all this crucial material, remember, you're with ChannelVest, your expert in ETF strategies. Let's jump right in.
Yeah.
So, we begin with the critical question. Hashtag why these 3 high dividend ETFs could destroy your portfolio in 2026.
Well, we established a pretty dramatic thesis right at the start, didn't we? It's not about, guaranteeing failure. It's more about recognizing the catastrophic potential risk.
Right, the potential.
Exactly, especially in these high-income strategies, particularly ULTY. I mean, despite their huge popularity and those yields that just jump off the page.
Yeah, 124%.
24%. The underlying mechanics, whether it's that structural NAV decay or just simple sector exposure, they pose a genuine threat, a threat to capital preservation.
Especially for retirement income, yeah.
Definitely. We have to look past that shiny high yield and really understand the structural risks involved.
Okay, let's get into the stats then. The ones everyone's buzzing about. Hashtag the numbers that will blow your mind.
Yeah, and here's where the data gets, kind of contradictory. We're looking at an incredible 124% ULTY yield. Think about that, paying $6.26 annually on a stock that's trading around $5.04. Weekly distributions, too.
Wow.
And the combined assets under management for these 3, it's staggering, $78.8 billion.
Huge amount of money.
Then you've got QQQI offering a strong, tax-efficient 13.5% yield from its covered call strategy on the NASDAQ 100. And SCHD, the original Dividend King, has delivered a phenomenal 404% total return since it launched back in 2011. That proves its long-term reliability, right?
It does, but the internal contrast is, stark. ULTY just exploded, right? Hit $1 billion in 5 months.
Insane growth.
But its net asset value, the NAV, collapsed by 53%. Meanwhile, QQQI has seen this consistent, sustainable growth. It went from $1 billion to nearly $6 billion. And it absolutely deserved that Best New Active ETF award in 2025.
It just shows the market is rewarding that active, tech-focused income generation that actually preserves capital.
Okay, that brings us right to the core issue with, pretty much all covered call funds. Hashtag the covered call controversy nobody's discussing.
Right, and this is a really foundational warning. It comes mainly from Goldman Sachs research. They found that, traditional covered call strategies, they capture only about 65% of the market upside in bull runs.
Only 65%?
Yeah, but they keep 84% of the downside during crashes.
Ouch.
The translation is painful. You severely limit your growth potential, but you still bear the brunt of major corrections. So that's why, a lot of analysts warn these funds are basically treating long-term capital growth for short-term income.
But QQQI seems to be finding a way around this structural flaw. And here's the cliffhanger, folks. Since its inception, QQQI is showing only a minor 2.33% performance drag while consistently generating that huge 13.5% income.
Which is impressive.
It really is. By using index options and a different strike spread methodology, its structure is delivering an almost unheard of 92% upside capture, while still limiting downside exposure to 86%. This makes it a potential game changer in the whole covered call universe. Okay, so if the mechanics are that volatile, how did they actually perform? Let's look at the last 18 months or so. Hashtag 2024-2025 performance showdown. ULTY has been, a genuine roller coaster is the only way to put it.
Right.
It ended 2024 pretty much flat. Then it saw a strong plus 13.65 per 5 YTD comeback in 2025.
Okay.
However, you absolutely must remember the price collapsed, a massive 75% drop, falling from $20.55 down to $5.04. But here's the critical plot twist, the part that kind of defies logic.
Okay.
With the dividends reinvested, ULTY is actually UP a total of 14.26%.
No way.
Yes. The dividends are actually offsetting the catastrophic NAV decay, which I guess is exactly how these products are designed to function, right?
Technically, yes, but wow. In contrast, QQQI is just crushing it, sitting at all-time highs, basically 0% drawdown, and an enormous plus 41.42% total return since its launch.
That consistency with the high income, that explains the rapid growth.
Absolutely. Meanwhile, poor SCHD is lagging badly, stuck at only plus 1.78% year to date.
Wait a second. The dividend aristocrat, is barely positive. Why is the income king struggling so much? Hashtag why SCHD is struggling in 2025.
Yeah, that's a critical question, isn't it? SCHD is lagging badly because of the strategic choices they made during the May 2025 rebalancing.
Okay.
That move massively increased its exposure to energy up to 19.4% and consumer staples, 19.1%.
Oh.
Unfortunately, those were two of the market's worst performing sectors this year. So SCHD was basically sitting on the sidelines with only 8.2% in tech allocation.
While tech was exploding.
Exactly. Versus the S&P 500's, 35% concentration in tech. It just missed that massive AI-driven rally completely.
So even with its, 14-year track record and phenomenal historical returns, that sector imbalance is really hurting it in this market cycle.
That's right. Although analysts at TipRank still give it a 7 out of 10 score for potential. They're predicting a price target of $30.40.
Okay, so about 12.5% upside there.
Yeah, suggesting some upside if that long-awaited rotation into value finally happens.
All right, let's jump back to ULTY for a second and look under the hood. What are its underlying assets? Well, the holdings list itself is kind of strange. ULTY dedicates 15.1% to cash, which seems highly defensive, right?
Mm-hmm. Very defensive.
But then it pairs that with these hyper-volatile growth names like Rocket Lab, Palantir, and Nuscale Power.
Yeah, that's quite a mix.
And the unexpected strategy pivot was moving from 20 stable large cap companies to this highly concentrated basket of 30 to 40 hyper volatile small and mid caps.
And this is truly fascinating. It completely explains that 124% yield. ULTY essentially created a synthetic covered call fund based on America's most volatile stocks.
Yeah.
That generates massive premium.
That makes sense now.
But this pushed its risk profile completely off the charts. It led to a terrifying maximum drawdown of negative 26.85% just in April 2025.
Wow, almost 27% down.
Yeah. So if you cannot stomach that level of volatility, this product is absolutely not for you. Full stop.
Okay, now let's pivot to the fund that seems to be leveraging that tech growth correctly.
Right.
QQQI gives you direct exposure to the magnificent 7 tech giants while collecting that impressive 13.5% annual income. We're talking about critical top holdings like NVIDIA at 9.54%, Apple at 8.34%, Microsoft at 8.33%.
The big players.
Exactly. You get the powerful growth engine of the NASDAQ combined with highly efficient inflow generation. You can really see why the market loves it.
Yeah, and what's really crucial here, I think, is the Section 1256 tax advantage.
Explain that again.
Because they use index options, the income is automatically taxed as 60% long-term capital gains and 40% short-term capital gains. Doesn't matter how long you hold the fund.
Gotcha.
For high earners, this tax break can genuinely save thousands annually compared to, say, ordinary income dividends. Plus, QQQI demonstrates perfect execution. It maintains an institutional-grade 30-day median bid-ask spread of just 0.02%. Really tight.
And finally, let's circle back and revisit the core holdings of the reliable old warhorse.
Yeah, SCHD's top holdings are just defined by quality, aren't they? Pharmaceutical leaders, industrial giants like AbbVie, Cisco Systems, Amgen, Merck, PepsiCo.
Solid names.
The strength of this portfolio isn't market momentum. It relies entirely on its core investment principle, that rigorous quality filter.
And that filter is the secret sauce. It ensures they only hold companies with 10 or more years of continuous dividend payments, low debt, strong, reliable cash flow.
Pure fundamentals.
Exactly. It's a pure fundamentals-driven machine targeting safety and predictability. That's why their average dividend growth rate is a solid 9.01% over 3 years. The sector breakdown just confirms this defensive posture. 19.4% energy, 19.1% consumer staples, 16.5% healthcare. Very defensive.
Okay, time for the money round. How much does all this income actually cost you? Hashtag tag expense ratio battle royale. We'd have to talk about the cost shocker here. SCHD is an industry-leading low cost at a tiny 0.06%.
Almost free. Practically. QQQI is significantly more expensive at 0.68%. And ULTY, highest by far at a chunky 1.30%.
Okay, but here's the analytical context you need. For ULTY, that massive 124% yield, it completely overrides the high expense ratio.
How so?
Well, think about it. A $10,000 investment generates $12,420 annually. So the $130 annual fee is basically a rounding error if your only goal is maximum current income.
Okay, fair point.
And QQQI is 0.68%. It's fully justified by the active management needed to execute its complex strategy and provide that superior tax structure. You're paying for that expertise and efficiency.
All right, we've seen the yields, but the Sharpe ratio, that's the true measure of efficiency, right? Get ready for the shocking truth about the Dividend King's risk profile here. QQQI wins decisively. A strong 1.14 Sharpe ratio, meaning it's generating the most return for every unit of risk taken That's what you want to see.
Absolutely.
ULTY is respectable at 0.94, which, honestly, is surprisingly good given its extreme volatility strategy.
It is surprisingly good, but the absolute core analytical shocker, it's SCHD's incredibly low 0.29 Sharpe ratio.
Wow, 0.29.
Yeah. This raises a vital question. Why is SCHD the champion of long-term track records, delivering such poor risk-adjusted returns recently?
Right.
It means investors are basically enduring unnecessary volatility for less relative gain compared to the others right now. The beta analysis confirms this too. It's ultra-defensive, registering a beta of just 0.29.
Okay, let's look forward then. What do the analysts think these three funds will deliver in 2026? Analysts are predicting a pretty strong year overall, it looks like. ULTY has a target of $5.44. That's about 9.20% upside from here. QQQI is targeted higher at $61.42, or 11.53% upside. And SCHD projected at $30.40, a healthy 12.46% upside.
Yeah, and the bull case for QQQI is actually massive. Its momentum is really driven by NVIDIA and that enormous, $4 trillion AI infrastructure spending surge.
Trillion with a T.
Exactly. That could push its high-end estimate towards maybe $74.49. SCHD's upside, on the other hand, is entirely dependent on market sentiment shifting back into value stocks.
And rotation.
That's what supports its long-term forecast of maybe $35 by 2027, driven purely by that steady 8-10% annual dividend growth.
Okay, before we move on to the Fed's impact and that critical tax time bomb we mentioned earlier, take a quick moment, smash that subscribe button, and let us know down in the comments which of these three ETFs you currently hold. We'd love to know. All right, let's discuss the biggest macro factor looming on the horizon. This changes the math for pretty much every investor out there. The consensus among macroeconomists is, well, it's absolutely crystal clear right now. 115 out of 117 economists predict another 25 basis point rate cut soon.
Yeah, it's pretty much unanimous.
Goldman Sachs is even forecasting maybe 2 more cuts before the end of the year. This isn't just news, it's a fundamental shift in the landscape.
And this shift creates 3 critical effects, specifically for these funds we're discussing. First, SCHD finally gets its rotation moment.
Ah, the value rotation.
Exactly. When rates fall, income-seeking capital moves out of safer cash and bonds and into higher-yielding dividend ETFs like SCHD. Its yield becomes far more attractive. Second, QQQI's Section 1256 tax efficiency. It becomes even more valuable as investors look to maximize every single dollar of return.
Makes sense.
And third, for ULTY. Its volatility premiums are likely to stay elevated due to market uncertainty around rate cuts, which should keep those huge distributions relatively stable even if the price doesn't recover.
Okay, speaking of maximizing dollars, let's talk about the nightmare scenario hidden inside those massive ULTY distributions. Hashtag the tax time bomb nobody warned you about.
This detail is absolutely critical, especially for high earners. ULTY has a frankly staggering 5,298% payout ratio.
5,000%.
Yeah. And here is the tax problem. 12.82% of its distributions are classified as return of capital, or ROC.
Okay, why is ROC bad?
ROC is a tax time bomb because it reduces your original cost basis in the investment. So when you eventually sell your shares, you could face a much larger capital gains tax bill than you expected.
Ouch, sneaky.
Very sneaky. If you're a high earner, say in the 37% bracket, a tax bill on that $12,420 annual payout from a $10 investment could be around $4,006 yield. That drops your after-tax yield drastically down to maybe 84% because most of that distribution is taxed as ordinary income, not qualified dividends or capital gains.
Okay, contrast that with QQQI again.
Right. QQQI's Section 1256 advantage means the blended maximum tax rate is only 26.8% instead of that top 37% ordinary income rate. That can save high earners hundreds, maybe thousands annually. And SCHD. It's by far the cleanest of the bunch tax-wise. Most of its payouts are qualified dividends, taxed at a lower 15% rate for most investors. Much simpler.
So we have 3 radically different funds here. Given all this data, I mean, who should actually own what? Let's break it down.
Okay, let's try to simplify. ULTY is really only suitable for those seeking absolute maximum current income, and critically, only in a tax-advantaged account like an IRA or 401k.
Why only tax advantage?
So you can completely ignore that negative 20% and negative 30% price volatility, avoid the ROC tax nightmare, and you basically don't care about capital appreciation, just pure income.
Got it. What about QQI?
QQQI is probably the best choice if you want essential tech exposure, getting that magnificent 7 growth combined with high income, and you value that significant Section 1256 tax efficiency. It's for growth and tax smart income.
Okay. And SCHD?
SCHD is really reserved for the long-term, patient dividend growth investor, someone who prioritizes the lowest expense ratio and those high-quality companies. But you must be prepared to wait through periods of, well, potentially extreme underperformance like we're seeing right now, driven by its sector allocation. If you need income today, SCHD simply won't cut it compared to the others. It's a long game.
All right, time for the final call then. The rankings for next year and the specific portfolio strategy we'd recommend based on all these findings.
Okay, crunching the numbers and looking ahead. Our rankings for 2026 expected total return are pretty clear. First place goes to QQUI. We're expecting plus 18% to plus 22% total return there.
Strong.
Yeah, fueled by continued NASDAQ 100 strength and that accelerating AI spending we talked about. Second place is SCHD, expecting a more conservative but reliable plus 14% to plus 16% as those potential rate cuts drive capital back into value stocks. And third place is ULTY, expecting maybe plus 8% to plus 12% total return, relying entirely on those volatility premiums to carry the fund because, frankly, NAV recovery seems highly unlikely at this point.
All right, so based on those rankings, how would you put them together in a portfolio?
We've built what we're calling the Goldilocks Portfolio. It's designed for moderate risk investors, maybe aged 40 to 60. The logic is pretty simple. Allocate 40% to QQQI as your core growth and income engine.
40% QQQI.
Then 35% to SCHD for that essential stability and long-term dividend ballast. Need that anchor.
Makes sense.
And just 10% to ULTY, but critically only housed in tax-advantaged accounts. Cannot stress that enough.
Okay, 10% ULTY, tax advantage only. That leaves 15%.
Right. Keep the remaining 15% in cash or perhaps short-duration bonds as an opportunity fund ready to deploy when needed.
Wow. We just synthesized 15 segments of pretty complex financial analysis. If you want shortcuts to being this well-informed every single week, do us a favor, hit that like button, subscribe right now.
And just a quick reminder, please remember, this analysis is strictly for educational purposes only. It does not constitute investment advice.
That's right.
Always consult a registered financial advisor before making any investment decisions based on these findings or anything you hear from us.
Absolutely critical. Okay, that wraps up our deep dive into ULTY, QQQI, and SCHD, but trust me, we are not finished digging into the market's biggest secrets. Coming next, you won't want to miss this. We found the secret Federal Reserve model that predicts Bitcoin's exact response.
Oh, interesting.
Yeah, we have internal Wall Street documents showing the one metric that has predicted every major cryptocurrency crash with, get this, 95% accuracy.
95%.
Yeah, don't miss this one. Subscribe now and make sure you hit that notification bell.